Welcome back to the part 2 of the video where I compare Canadian National Railway and Canadian Pacific Railway stocks and see which one is better stock to invest in. If you have not seen the part 1 of the video, please click the link at the top right corner and then come back to this video. In the first video, I have gone through Canadian National Railway's financial statements and looked at some of the fundamentals of the company. In the first half of this video, I'll be looking at the similar data for Canadian Pacific Railway, and then we'll be comparing some of the key data points that define a company and see which one has the upper hand. Canadian Pacific Railway is a historic company that was first built to join Eastern Canada and British Columbia between 1881 and 1885, fulfilling a commitment extended to British Columbia when it ended the Confederation in 1871. Now, based in Calgary, CP is the second largest Canadian Class 1 railroad, providing freight transportation services across 13,000-mile network in Canada and the US. CP Networks serves every major sector, shipping from grain, coal, potash, metals, chemicals, forest products, automobiles, etc. CP serves 9 ports on west and east coast and has the major border crossing in Western Canada. They have more than 100 transload facilities and have a workforce of around 13,000 railroaders. Out of its revenue, 24% is from shipping grains, 21% from intermodal services, 14% from petroleum and chemicals. Metals, minerals, coals, potash, automotive, and forest products are other major commodity groups. Let's look at the balance sheet of CP. Total current assets seems to be consistently increasing for the last 3 years. Year 2017 had a higher amount compared to 2018 and 2019 though. They had more total cash in 2017 compared to 2018 and 2020. We have to look at cash flow statement to understand more about this. On the other hand, total assets, it is increasing year after year. For total current liabilities, we see a similar trend as that of CN. It decreased in 2018 from 2017 and then in 2019 it increased. I would say a similar pattern as of CN Rail. But the current debt has increased in last couple of years and almost doubled in 2020. This is the opposite of what we saw in CN Rail, where the current debt was decreasing. However, for long-term debt, it maintains the same pattern as CN Rail. It has increased in 2021, 8.5 billion in debt. CN had $11 billion in debt, but we have to remember that CN has double the size of assets as well when compared with CP. But irrespective of this, the total stockholders' equity increases year after year, which is what it matters at the end. So irrespective of those increase in debts, the balance sheet still looks good. Now if we look at the income statement, we can see that the total revenue and gross profit the company did well even for the year 2020. The year where COVID created a lot of restrictions. This is completely different than what we saw in the case of CN. Total operating income also increased year after year. But one thing I want to highlight here is for the year 2020, even though the total operating expense was less, maybe because of the COVID restrictions and lockdowns, it never impacted the income in any way. That shows how well the management has performed. So I am really impressed with the income statement of CP when compared with that of CN. Just like how we calculated the profitability margin of CN, we will do the same with CP's numbers. This straight away shows how it performed compared to CN's. For 2017 and 2018, CN showed a better number, but after it's all CP and year after year it increased. So based on income sheet alone, CP is a clear winner. However, that's not the only data point we should look at. So let's check the cash flow statement as well. So for cash flow from operating activities, it increased consistently. 2020, there was a little bit of down, but increased a lot in the last 12 months. For investing activities, just like CN, majority of this cash company has invested in itself, which I mentioned before is a good sign. That is what you want to see. Made some acquisitions in 2020 and 2019 as well. Now, under financing activities, CP has spent a lot of money on repurchasing the shares, some on dividends and debt repayment. That is also good as well. But overall, if we look at the net change in cash, it is a positive amount except for the year 2018. And free cash flow increased year after year as well. So a pretty good cash flow statement as well. I would say pretty much similar to that of CN, though it edges a little bit over CN in certain areas. Let's have a look at some of the fundamentals of both these companies side by side. As we know, CN is the largest railroad in Canada. So obviously, if we look at the market cap of both, CN is almost the double of CP Rail. CN is at 106 billion, whereas CP is at 58 billion. For the PE ratio, that is price to earning ratio, which is mostly used to determine the stock valuation, whether the stock is overvalued or undervalued, it relates a company's share price to its earning per share. A high PE ratio would mean that a company's stock is overvalued, or else that investors are expecting high growth rates in the future. It is calculated by dividing the price of the share by company's earning per share. The PE ratio of CN is 26.73, whereas CP is 18.02. So based on the numbers, CP's 18.02 looks attractive than the high value of CN. But this alone does not help us to pick a company. So let's look at the next pillar. PB ratio. Price to book ratio is calculated by dividing the price of the share by the book value of the company. It measures the market's valuation of a company relative to its book value. So the book value of a company equals assets minus liabilities. So here CN is 5.25, whereas CP is 6.46. That is, CP's investors are paying 6 times the value of the share. So the lower, the better. Here the point goes to CN. However, note that there is not much difference between the both. Book value of equity per share effectively indicates a firm's net asset value, that is total assets minus total liabilities, on a per share basis. When a stock is undervalued, it will have a higher book value per share in relation to its current stock price in the market. It also measures the amount one will receive per share if the company liquidates. For this data point, also CN outperforms CP. CN has a ratio of 28.73, whereas CP has at 13.44. The next two data points determine how the company performed. First one is profit margin, which is the data point to evaluate how efficiently company was able to convert the revenue into profits. CN has a percentage of 28.27, whereas CP has an amazing ratio of 41.18. This is calculated by taking the two data points from income statement, net income divided by total revenue multiplied by 100. For a railroad, operational margin is an important factor. It shows the operational efficiency of the company. CN has a ratio of 40.13%, whereas CP has a bit higher of 48.19%. So these two data points are in favor of CP. And that is the reason why we see that CP stocks has performed a little better than CN in the last 5 years. Now let's look at those fundamentals that highlight the efficiency of the management. These are return on assets, ROA, and return on equity, ROE. CN has a 7.8 percentage of ROA, whereas CP has a better percentage of 9.8 percentage. ROA is calculated by dividing net income by total assets, which is in short means how much money company was able to generate based on its assets. So the number says CP did a better job than CN. Return on equity. This one is a little tricky. The numbers won't always give the complete picture. ROE shows how efficient the management is in to generate the profits based on the money invested in it. The formula for ROE is net income divided by shareholders' equity. And we know shareholders' equity is same as the book value, which is total assets minus total liability. This is where it becomes tricky. Ideally, a high ROE means the company is doing good. However, since the book value is in the denominator, a low book value can give a high ROE. And a company, let's say, can borrow a lot of money and can generate a good income. In that case, the book value will be less, whereas ROE would be high. So typically we want a consistent book value and a good ROE to determine the health of the company. So let's compare the assets and liabilities of both these companies. This is for the year 2020. CN is a bigger company than CP. So obviously they have a higher asset and liability. Also the book value or shareholders value of CN is higher than CP. Since we are comparing a large company with a medium-based company, we can use the formula of assets divided by liabilities. CP has the value of 1.44, which is lower than CN's 1.78. So CN has a better assets to liability ratio, but the difference between the two is not much. So with this information, we can go back and compare the ROE of both these companies. CN has 20.52 percentage, whereas CP has 39.54 percentage. That means for every $1 equity, CN has 20 cents of profit, whereas CP has 39 cents of profit. That is the tick mark for CP. The net income for 2020, CN has a better income. However, based on the size difference in all other aspects, the difference in net income between the both is not considerable. And that is the reason why CP has an edge on CN over ROA and ROE. But CN has twice the revenue of CP, and hence they have a better revenue per share of 19.98 compared to 11.77 of that CP. This data point, however, is for trailing 12 months. The logic for this is trailing 12 months revenue divided by average common shares outstanding from the trailing 12 months. Based on all these data points that we looked at, CP have a slight edge over CN. CP has shown a good growth in the last 5 years compared to CN. However, CN has always been a lead runner for the two if we look at a historic data. Last but least, I will take you to two recent articles. The KCS merger is a great victory for CP. On a long run, this will definitely benefit the company. However, as this section highlights, CP has to take a considerable amount of debt to get this deal over the line. By the end of the deal, CP expects that its outstanding debt will be approximately $20 billion. So for me, in the short term, this will impact the company's numbers. So for the next 3 years, will we be able to see the similar growth that we have seen in the last 5 years? I doubt so. Now let's look at an article about CN. After the failure of acquiring KCS, CN has received some criticism from TCI Fund Management Limited. CN faces a proxy fight from TCI, which owns more than 5% of the company, and it is unhappy about its performance and its decision to pursue a $30 billion takeover of Kansas City Southern. As a fight back, CN said it plans to cut spending, streamline management, and buy back $5 billion of stocks next year. The measures will allow the railway to increase operating earnings and profit per share by 20% next year and to improve its operating ratio. Company plans to increase operating profit by Canadian dollar of 700 million, including Canadian dollar 550 million from cost cuts and 150 million CAD gain from price increases. Of the cuts, about $250 million will come from reducing management and union workers. So this, if go as per plan, will increase the company's numbers year to year and will be welcomed by investors. Based on all the above factors, what would be the verdict? The last 3-4 years, CP has an edge over CN. But by the acquisition of KCS, initially they may not be able to produce the same level of growth that we have seen before. So I see CP as a long-term company to hold and buy in dips. CP-KCS would start yielding more profit as the company grows into each other. So this is a great company for a long term. As for CN, it's a huge company and a failure to acquire KCS will definitely result in some changes in the organization, and we have already started seeing this. As a result, they will definitely see some great results in coming years, and that means there will be instant growth for the next couple of years, and then from there it can probably take the momentum to a long term. I am bullish on both these companies, seeing a good bet for short term, whereas CP will do wonders in a long term. What are your thoughts? Have you invested in any of these two stocks? Share your thoughts in the comment section. That's it from my side for today. We'll come with a different topic soon. Till then, take care.